YieldMax sounds like a dream for retirees: maximum yield, steady checks, low effort. But here's the truth. Most glossy brochures skip. The strategy relies on covered calls, meaning your upside gets capped while your downside stays wide open. Let me break that down in plain English. When you sell calls, you get cash today. That's the yield. But if the stock soars, you're locked out of most of that gain. If the stock falls, you still own the falling asset. The option income rarely plugs that hole. So what happens over time? The only way to keep your original investment from shrinking is to reinvest a good chunk of those juicy distributions back in. And once you do that, the wow headline yield turns into a pretty average total return, often worse than just owning a broad index. It's a caffeine-high monthly payouts, double-digit yield, instant gratification, then the crash hits, capped growth, principal erosion, constant need to reinvest just to stay afloat. For retirees, that's a problem. You need dependable income that doesn't quietly drain your nest egg. YieldMax style funds tie your future to a few volatile names, synthetic covered calls. Volatility makes the payouts look huge in the short run, but volatility also cuts both ways. Drawdowns can be brutal. Let's talk sequence risk. If you retire into a bad market and you're spending those distributions instead of reinvesting them, your principal can slide fast. Then the next year, you're earning yield on a smaller base. That math compounds against you. Taxes matter too. A chunk of these big payouts can be return of capital. It feels like income, but it may just be your own money coming back, lowering your cost basis while the fund's NAV trends down. You can't spend the same dollar twice. Meanwhile, the opportunity cost is huge. Covered calls chop off the part of compounding that creates real wealth. Long-term upside, miss enough big up moves, and your retirement portfolio becomes a treadmill. Lots of motion, not much progress. Ask yourself, would a patient, long-game investor sign up for this caffeine rush? Can you picture Warren Buffett chasing a 15% yield that trades long-term growth for short-term sizzle? Absolutely not. He buys great businesses, lets compounding work, and avoids complexity that looks clever but bleeds over time. If you crave income, there are saner options: a diversified equity and bond mix, a low-cost index core with a measured withdrawal rate, tips ladders, investment-grade bond funds, a slice of dividend growth stocks that raise payouts over decades. None are perfect, but they're built for staying power, not thrill rides. Here's my bottom line. YieldMax's promise is front-loaded. It feels good now, and it often hurts later. If preserving principal matters, and for retirees it does, chasing maximum yield with capped upside and open-ended downside is the wrong game. Play the long game, favor durability over drama. Total return over headline yield strategies that don't need a constant reinvestment bailout to stand still. Your future self will thank you.